Hi, everybody, and welcome. I'm Leslie with the New Mexico Small Business Development Center, and I'm here with Tommy Thompson. And I'm pleased to introduce Tommy to everyone because he is one of our resource partners, SCORE Certified Mentor, and I'm sure he'll tell everyone about SCORE and also about the webinar today. He's got some great information. Cash is king. Of course it is. Cash management for your small business. I'm going to be chatting some information through the chat function to you. There's a handout that Tommy has. I'll make sure that I send you the link to pick up those the handouts that are available on our website. I also want to remind you, if you have any questions, don't be shy. Type them into the Q&A. Tommy will pick them up. I'll find a spot that we can get the questions in, and Tommy will answer them for you. So with all that, Tommy, I'll turn it over to you.
Thank you very much, Leslie, and good morning, everybody. I hope we all had a good Labor Day weekend. I know it's a little fast to pick up right after a weekend like this, but we're going to dive right into it. This morning, we're talking about the reasons why cash is king and how you can use that concept to better manage cash in your small business. As Leslie said, I am with the SCORE Association, the resource partner for SBDC for this series of programs. I've been a SCORE business mentor for about 10 years since I moved out here to New Mexico. Previous to that, I spent my career as a corporate financial advisor and corporate financial troubleshooter. I get to put a lot of letters after my name. 3 of them are CPA. I'm retired now, but I still use the skills that I developed then to help small businesses today. A little bit of guidance for our presentation. Your audio has already been muted. And I want you to make sure that you set your Zoom ratio, which you can find up there at the top of your screen or the bottom of the screen, to fit window. That will fill your whole screen with this window and make it easier for you to read some of the type in the slides, some of which is a little bit small. We'll be using the Q&A function to take questions as questions occur to you. Pull up the Q&A down at the bottom of your screen and type in your question. Write down the related slide number, if you would, along with your question. That would be great. That will help us get back to that specific slide to address your question. Now, what we're going to talk about today is we're going to talk a little bit about where you can find training, offering, and counseling assistance from SBDC. We're going to talk about the objectives of this program. We're going to talk about this program, cash flow management and record keeping. We'll take your questions and address them and hopefully have a little bit of time for discussion. And then we'll also talk about the next steps in our program and things that you can do today to help begin keeping cash flow and its importance up at the top of your mind. Now, for training, offering, counseling assistance, go to the SBDC website. They are at nmsbdc.org. Again, nmsbdc.org is the site to go. They have both buttons there for training offerings, for cybersecurity, pandemic response, and a whole bunch of other topics. You can also use the information there to request no-cost business counseling for your small business, and also loan application assistance for any of the related, pandemic-related and other economic-related loan programs that there are out there, offered by the feds, the state, the city, whoever. Now, what we're going to talk about today is what cash flow is. What is it? What makes the cash flow through your business? We're going to talk about some cash flow principles in terms of managing that cash flow. And to implement those principles, we're going to need to know how to forecast cash flow and also some tactics that you can use to help your incoming and outgoing cash come in as fast as possible and go out as slowly as necessary. And finally, we're going to say a few words about the record keeping you need to have for pandemic relief programs that you may or may not have taken advantage of over the course of the last year and a half. Now, we all have to remember that cash is king. Cash is the lubricant that keeps business running. It's the exchange medium that we all float our businesses on, and that continues to keep the business moving, even if sales are a little slow, even if your vendors are a little lackadaisical or a little demanding. If you have the cash you need to operate your business, then you're still in business. because when you run out of cash, your business will crash. And without the lubricant that cash flow provides, you don't have any way to conduct business. You don't have any way to get goods to your customers. You don't have any way to pay your vendors. You don't have any way to pay your people. So your business just crashes. So keep that in mind, and that cash is the king thing in your business, and it needs to be up at the top of your mind, just like the king up there on his throne, because that's what keeps your business operating. Now, what is it? I like Yogi Berra's definition, and they pay in cash, which is just as good as money. Oh, Yogi was pithy in some of those yogiisms that he came up with, and that one's not a bad one. However, if we're going to define it a little more academically, it's the net amount of cash and cash equivalents, that's stuff that you can turn into cash instantly, that are transferred into and out of a business. At the most fundamental level, you create value for yourself and any other stakeholders in your business by your ability to generate positive cash flows, to maximize your long-term free cash flow. When I say free cash flow, that's cash that's not needed for any other purpose by the business. All right, it's not needed to pay back loans. It's not needed to pay vendors. It's not needed to buy capital equipment. It's free. It's available to the investors to do with what they want to do. So keep that in mind. Your ability to create value in your business is determined by its long-term ability to generate cash flow. Now, what makes up cash flow? Well, as you might imagine, it's cash money coming into your business first. And that represents sales for cash. If you're in the retail business, it's sales and credit card payments that are coming across your sales counter. It's collections on accounts receivable. If you're in a business that deals in credit for your customers, collections on those customers are what count as cash. Deposits your customers might make to you in the course of setting up a transaction, prepayments for services or goods to be delivered or rendered in the future. It also, all those things are part of your profitability statement. They're part of your regular business operations. There's also cash that comes into your business that doesn't come from operations. It comes from other sources. First of all, the other kinds of sources it can come from are bank loans, loans from yourself to your business, money from family and friends and fools who want to invest in your business or otherwise extend you a helping hand. And then it's also cash comes in lately from various pandemic relief loans, grants, the payroll protection program, for example, the economic injury disaster loans or EIDL, state pandemic assistance, federal and city even grant programs that bring cash to your business. Sometimes that cash needs to be repaid. Sometimes it can be converted into a tax-free grant. Sometimes you might have to account very specifically for how you use that cash. In all cases, it's any cash that comes into your business that you have immediate access to and can immediately use to help your business. Now, cash flow going out is also part of cash flow. Remember, it's a flow. It flows through your business, just like a fish swimming upstream or through the stream. Now, the cash money going out obviously are all your operating expenses. It's compensation to your employees. It's benefits and taxes to your employees. It's payments on your vendor accounts, right? If you get credit from your vendors, payments on that accounts payable is cash flow out. It's rent to your landlord, okay? Under the terms of your lease, rent cash goes out. And it's all the other operating expenses that make your business flow. Your marketing, advertising bills, your phone bills, your utility bills, all of that stuff is cash going out. Now that's considered part of your profitability statement, right? But that's not all that you have to put cash out for. You also have to put cash out in order to buy capital equipment to keep your business competitive. You have to repay bank loans that you may have taken out to buy that equipment. Those kinds of things going out are not part of your profitability statement, but they are cash flow out. In the same fashion, owner draw, taking out enough money to buy the groceries for you and your family. That's cash flow out. Repayments or dividends or interest that you pay to family, friends, and fools, that's your cash out as well, because that's cash that you're obligated to pay back to family and friends and so forth. you can see that cash flow is different from profitability. There are several things that come in that are not part of profitability. There are several things that go out that aren't part of profitability. It's all part of cash flow, though. There's more sources and more uses of money. Now, what isn't cash flow? In a normal accounting system, when we make a sale, whether it's for cash or on credit, we record the sale. And on the other side, we record whatever expenses were related to making that sale, such as the cost of the goods sold that went out the door, or the cost of the service technician's time that provided the service. All right. When we make a sale on credit, all right, the customer hasn't paid us yet, have they? They're going to pay us sometime in the future. So a credit sale is not part of current cash flow. In the same way, when our vendors extend us credit, purchases on credit aren't part of current cash flow because I haven't actually written the check and had it go out of the bank account yet. So keep that in mind. The kinds of things that make up our normal accounting have to be adjusted to reflect the fact that the cash is coming in and the cash is going out at different times than the sale or the expense is incurred. All right, that's important to keep in mind. Now, the basic strategy for cash flow management, you have to work at it. It's just as important, if not more important, than getting new customers. It's just as important, if not more important, than servicing your existing customers. It's just as important, if not more important, than you getting the name of your business out into the world. Okay, so you have to work at it. It has to be up here. It has to be at the top of your mind all the time. And if it is, then you have a better chance of getting a handle on it and being able to talk to people and stakeholders intelligently about what your business is doing and what your cash flow needs are. Now, in order to work at it, the first thing you have to have is some funny idea of what's going to happen, when it's going to happen, why it's going to happen. And that means forecasting your cash flow. Now, we're all familiar with budgeting in a business, okay? Forecasting cash flow goes right along with budgeting in a business, all right? And it just requires a few certain tweaks and tricks to get your cash flow forecast out of your budget profitability forecast, all right? Once we've forecasted cash flow and we have an idea of what's happening, what we think is going to happen in the future, now we've got to track cash flow. You got to track it so you can figure out what's different, why it's different from what you had planned. No plan survives picking your pencil up off the paper that you write it on. All right, be aware of that. And you just go with that. And what you try to do is you try to find out the reasons why your assumptions about cash flow are different from what actually happened in cash flow. And then you modify your assumption for the forward-looking part of your cash flow forecast. All right. When you track it, and any modern accounting system will track cash flow for you. When you track it, you can figure out what was wrong with your assumption or what conditions have changed that make that assumption obsolete, and now you need to modify it. And when I say modify it, what I mean is your forecast needs to be modified every time you find out an assumption has changed. All right. And what I tell my customers, clients, and SCORE is to prepare a cash flow forecast that goes forward for 12 months and then update it every month. Because only when you're looking forward on a continuing basis do you get an outward look at what's likely to happen before it happens. And you can take steps to deal with it before it happens. All right. Once you can forecast cash and once you can track it, then there's some tactical things that you can do to speed up the cash coming into your business and to slow down the cash going out. All right. Now that's easy for me to say. That's why I put the question mark after slow down cash out, because there are things you can do, usually on a temporary basis, usually with the acceptance of your stakeholders and vendors, that will give you a little bit of breathing room in terms of getting cash out the door. We'll talk about those tactics in a little while. But the first thing we're going to do is talk about forecasting. Forecasting starts from the premise, what's my cash today? What is it right now? What's coming in? When's it coming in? Why is it coming in? All right. And what do I think about when it's coming and why it's coming is an important part of the assumption set that goes into a forecast. Because we're forecasting the future, we're making assumptions about what's going to happen, assumptions about sales, assumptions about operating expenses, assumptions about vendor payments and vendor credit. All right. Similarly, we're also making the same set of assumptions, slightly differently, about what's going out, why it's going out, when it's going out. And then finally, if we net together what I have today with what's coming in and what's going out, I arrive at a number of what my cash should be out in the future at some point, usually the end of a month. All right. Now, if we take that concept, we can set up a spreadsheet in this case and develop that forecast going forward. Now, I'm indebted to an author named Philip Campbell for allowing me to use this example. It's taken from his book, Never Run Out of Cash, which is which is available free at his website, neverrunoutofcash.com. Now, of course, he wants to say other books he's written, which is why this one is free. But this does make a good start on a cash flow forecasting tool. Now, I've only put the first 6 months up here. The whole spreadsheet, which you can get through the links that Leslie will send you, that whole spreadsheet goes forward for 12 months. But in the same way that I just said, you want to update that schedule every month, you're going to want to update your cash flow forecast every month. And then the lines at the top just change. Your starting line instead of January could be September, which started last week. Okay. It could be October, which starts October 1st, obviously. But whatever month you're starting is your first month of 12. And every month you update by looking out another month and seeing what you see coming. Now, this looks a lot like your profitability statement, doesn't it? I mean, we've got sales up here, we've got cost of goods sold, we've got gross profit, we've got operating expenses, we've got a total expense line, and we've got a net income line. Except here, a couple of things are a little different. Up at the top, ahead of sales, we've got a beginning cash balance line. Right here where it says in January, we're going to start out with $10,000. That's our starting balance for January. Your balance may differ. And down here at the bottom, instead of labeling this net income, we label it with some funny acronym called EBITDA. Now, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And what it is a proxy that's used by corporate financial analysts, those people who study big companies, to develop a sense or an idea of what the operating cash flow of the business is without any other adjustments, just EBITDA, okay? And what that does is it gives them a cash flow proxy for operations that they can then use in analyzing the prospects of the business going forward. All you need to know for our purposes is that's your operating cash to start with. There's other things going on that are going to affect it. We're going to talk about those in the next 2 or 3 slides. But for right now, instead of net income, it's EBITDA because we didn't put any interest in it. It doesn't reflect a deduction for taxes. It doesn't reflect a deduction for depreciation, all right, which is how you use up capital assets. So this is the profitability side of our forecast. And then we go into a couple of 2 other sections that don't actually affect profitability very much. Section 2 of this template is called debt service. And that's the principal and the interest. Now, here's where we take out the interest, right? This is the cash that has to go out of the business to service debt, whether that's a car loan or an equipment loan or any other type of loan you have in the business. It could be a revolving credit line with the bank to support inventory and receivables, all right? But any cash going out for debt service shows up on this line. We gave you note 1 and note 2 here. We gave you another line for it. You could add in lines yourself as you adapt this to your business's needs. Now, the section 3 of this is cash going out, not to repay debt that you've incurred, but to get new equipment, to get new stuff into your business. It's for capital expenditures, vehicles, machinery, office furniture, if it's a big enough expense, building additions, property, plant, and equipment of any kind. And here, what we're accounting for is the cash that's moving out to pay for those things. And this is the cash that's moving out to pay for those things. You might have a line in section 2 under debt service where you take on a new loan. All right. And that's cash coming in. It's not part of profitability, but it is cash coming in. And then you see that cash being used to purchase the capital equipment, either in the same month or in a subsequent month. All right. Now, the next slide is where the rubber meets the road. This is where we make all of our adjustments to what's called accrual accounting to get ourselves back to what the cash really was. All right. And the first one of those is that we add back to our cash flow the cost of goods sold. Presumably, if you're in a goods business, you bought things into your inventory some time ago, a month, 6 months, a year, whatever. But you bought that into your inventory, and the cash to buy that into your inventory moved some period ago, not now. So in the now period, we add back that cost of goods sold line, but we deduct what we actually spent in cash this period to buy things for inventory. All right. So all the money we spend to put things in inventory, whether that's raw materials, direct labor, factory supervision, factory overhead costs, all that is that inventory purchase line. And that gets deducted because, after all, it was cash out the door, right? Follow me? Good. Now, we also are going to deduct sales. Now, we assume in this example that we have made sales on credit. So our January sales of $15,000, if we go back here a couple slides, see that 15,000? We assume that's all made on credit. And we deduct that because it was made on credit and it didn't bring cash in the door, did it? No. So then we add to our cash flow all the cash we collected from current month sales and all the people who paid us based on sales we made in prior months, usually the last 1 or 2, hopefully not too much in the last 3, right? And that's the cash that came in the door to pay down that accounts receivable balance, plus any sales we made across our counter, right? The cash came in during the month. Now, we would normally accrue taxes into our profitability statement, right? Because they're an expense item that we incurred, but we don't actually pay them as we accrue them, do we? We usually pay them quarterly. So here's the estimated tax payments. Remember, earnings before interest, taxes, depreciation, and amortization, right? So here's when we pay the taxes. We usually pay them quarterly. Here's a quarterly payment in January. Here's a quarterly payment in April. Now, we put this in for when the cash actually moves. Then the next thing we do is we look at the change in accounts payable. Now, we get credit from our vendors, and we use it to buy things and bring them into the business. If we let our accounts payable balance go up during the month, that means that vendors extended us more credit. We got more stuff in the door, and that's just like having cash. So if our accounts payable go up, it's a positive number to our cash flow, the difference between last month and this month, right? Similarly, if we pay down our cash flow this month, so we have less owed at the end of the month, we've really repaid some of that trade debt, right? Some of that accounts payable debt. And we've done that by paying it down, which means cash went out the door more than goods coming in the door. All right. So for that reason, you put in the change in accounts payable. Here in January, we paid it down $500. In March, we brought it up $750. And then we paid it down $500 again in April and again in May. Again in May and again in June. Now, there's a couple other lines here for you to add for whatever fits with your business, but those are the timing differences other cash flow items, and timing differences that adjust our accrual-based accounting profitability statement and balance sheet to our cash flow-based cash flow statement. When we add all that stuff up, okay, our EBITDA minus our debt service minus our capital expenditures and the difference of whatever the timing differences come out to be, here in January, it's a negative 4,375. When we add all those together, we net them out to get a line called net cash flow. And that's the net cash flow from all sources that we experienced during January. And during February, it came in at 4,700, 5,600 in March, 2,000 in April, 4,000 in May, 3,500 in June. This is nice. It's positive cash flow every month. You like it. We take that $10,000. Remember that $10,000 right up here in January? We add to it the $905 we generated during January, and our ending cash balance is $10,905. Now, you know, that's our ending cash balance at midnight on January 31st, and at midnight plus 1 second on February 1st, we now have $10,905 to start with. You follow that? It flows from the start through the activity back up to the start again. And that continues every month as we go along in our cash flow forecast. This is a pretty rosy looking cash flow forecast right here. Okay, now, a lot of businesses establish what's known as a minimum cash balance target. That's what they figure they have to have to deal with any unexpected bumps in their cash flow forecast. And so they'll always make sure to have so much money, in this case, it's $8,000 in the bank at all times. At a minimum, that's what we want. If we go below that, we're going to borrow money to bring it back up to that. If we go above that, we can do other things with the cash to bring it back down to our minimum where we want it. Or we can just let the cash pile up. And then when we subtract the ending cash balance from our minimum cash balance target, we get an excess or a shortfall in cash that we can talk about. And we can figure out what we're going to do with this cash now. Are we going to reinvest it in the business, new marketing techniques, new product offerings, additional staff? What are we going to do with that? Are we going to pay a dividend to our stakeholders, you know, our family, friends, and fools out there? Or are we going to just let it sit there and pile up? In this example, it just sits there and piles up so that we wind up at the end of June with a whole bunch of money that's excess to the needs of the business. And we could set quarterly goals for dividends and whatever else we wanted to do, or for business expansion projects like buying capital equipment that allows us to produce things more efficiently or produce greater quantities of things that we can then continue to ship to our customers. So this is the forecasting tool that helps you understand where things are going to be happening in the future. I know I've got to pay $3,000 for taxes in January. I know I've got to pay $2,500 in taxes in April. Okay. Those are the things that you can see. You can see them out in the future, and you can see that they're going to affect your cash flow, and you're going to need to have the cash on hand to make that payment. All right. Now, once you've got your forecast, track it. All the major accounting software packages that are out there let you create your profitability statement, let you create your balance sheet, and they let you create a cash flow statement. All right. And that cash flow statement is what you track against your forecast to see what's different. Not only what's different and how much it's different, but why is it different? Why did you not have the same cash flow that you forecasted you were going to have? And is that situation, is that reason going to recur, or is it a one-time thing? Right? And be realistic when you assess that. You know, a one-time thing that happens every month, every other month for a year is not a one-time thing. Right? Now you can track cash flow using your accounting system. You can track it every month. If you have a business that's smaller or that engages in fewer transactions, you might track it every quarter. All right. But I tell people, track it at least month to month. At least month to month. Now, this involves keeping your business accounting software up to date, keeping it posted, they call. keeping it all with all your records and record keeping it all posted up as to whatever transactions are happening when they're happening. Now, in an emergency, you might even track your cash flow weekly or daily. I once worked for a business in the 1980s called the Troy-Bilt Rototiller Company. Some of you may have heard of Troy-Bilt Rototillers, but they had we have a marketing department then that budgeted its year based on the promotions it was going to put out in the mail at the time. This is the 1980s, before the internet. So they had dates when they would drop the mail campaign in the Postal Service, and they had forecasted every day from that point forward what orders they expected to get. And then we could, in the accounting department, finance department, we could use that information to then create a budget for sales based on the lag time between the order coming in the house and the actual shipment going out the back door. All right. And they would track that number every single day against their forecast for every single day. And if it started to get ahead, they were happy. If it got below, they started scratching their heads to figure out why and what they could do about it in the next few days or weeks, right? Because they had what amounted to a real-time track, because the mail brought the orders in, or people called up sometimes. But that was the way that we tracked it. And we put out, from the finance department, we put out a flash report every day, which kept people's minds right at the top of their minds, all through the company, about what was happening. That flash report had on it our cash balance in the bank that day. It had on it whether or not we borrowed from the bank and how much. It had on it the number of orders we got in versus the number of orders that were forecast, right? Those numbers were top of mind for everybody in the company, from the president on down to the people working on the assembly line. We all knew about it. We all knew how things were going. Everybody in the company, and everybody in the company worked to make those numbers look good. Okay. And you want to do the same thing in your business. You want to be tracking against your forecast. You want to understand why your actual numbers are different from your forecast. And then you want to modify your forecast for those things you know are going to recur going out into the future. Keep that in mind all the time. Now, tactically, what do you do with that information? Forecast is information. Your tracking information is information. Your tracking data is information. What do you do with it to put your cash in the business quicker and to take it out slower? First things to do to accelerate your cash flow in is sell, sell, sell. Analyze your existing customers and their purchases. Call them up, offer more and related products. If your sales cycle says I'm going to call them once a quarter, well, call them once a month, or call them in an off week period, or call them when you see your sales getting soft out in the future, and offer them a deal, right? You offer them a pricing discount for fast payment, or even a better discount for cash with their order. That brings the cash in quicker. If it comes in with the order, you've got the cash before you actually have to send them the goods or provide the service. That's a good thing, right? But you offer them a deal to get cash in the door faster. And you can't offer them a deal all the time, because the various federal laws about, not having sales all the time means you have to be abiding by your published prices every once in a while for some part of the year. Now, notice I say under there, you've got to continue marketing and prospecting, all right? Your existing customer base will erode over time. Customers retire, they die, they get persuaded by a competitor to go with their competitor's products instead of yours. All those things erode your customer base. You constantly got to be building your customer base. You got to be building it up. And that means continuing to market and prospect for new customers. You want to do that all the time. You might do it at different levels depending on the urgency of your cash flow situation, but you do have to continue marketing and prospecting. I also tell my clients, use just one bank for all your banking activity. This isn't too difficult in a small business, but larger businesses sometimes come to have operations in several states or different parts of the same state where it makes some sense, or they might think it makes some sense to open separate bank accounts for customers to deal with, to look local or things like that. But use just one bank. What happens is when you use just one bank, your funds come together in that bank more quickly than if you have to transfer them from other banks. It takes an overnight usually to transfer money from one bank to another these days. And even that one night, if you're talking about a lot of money or important bills that need to get paid that you expect to hit the bank the next day, even that one day can be important to you. The other thing you can do to accelerate cash flow coming in is to borrow money. If you sell goods on credit, your customer's promise to pay you can be financed at a bank, but through a revolving line of credit. Similarly, you can also finance inventory to a certain extent using a revolving line of credit. When I say revolving, that means that you can pay it down or you can build it up within its limits anytime you want to, without having any prepayment penalties or things like that. You pay the interest on a regular basis, usually monthly or quarterly, but you also can pay back the principal or take out the principal with just a call to the bank to put money in your account or take money out of your account. Okay. And you want to match the type of borrowing that you do to what it's paying for. If you're buying a Jeep or some similar vehicle for your business, then a longer term car loan, level payment, fixed number of months loan might be more appropriate for that purpose than trying to do a revolving credit line. Okay. Revolving credit line lets you recognize that your accounts receivable and your inventories will go up and down in the normal course of your business. Well, a vehicle or some other piece of capital equipment doesn't fluctuate in value like that. And therefore, you can match out a term loan or a car loan to that particular purchase. Now, you can also apply professional collection techniques to collect your receivables faster. And what this means is developing a relationship with your customers at the service level, not at the sales level, but at the service level, where you are in touch with them and making them aware that you're keeping an eye on their account with your business. And by keeping yourself up at the top of their mind when they're making choices as to who to pay this month, you're up there and you're one of the people that they want to keep in mind of paying. Okay. You use professional collection techniques. You don't call them up to hector them. You call them up, you talk to them about how their business is doing, how things are going, and whether they foresee any cash flow issues that would prevent them from paying you within the proper terms. All right. Now, to accelerate that cash in with some of your customers that you're not quite as sure how good credit they are, you could tighten up the credit requirements and reduce their open to buy limit, for example. All right. Where if you previously had extended them $30,000 a month worth of credit, you might tighten that to $20,000. If they're continuing to buy from you, that will force them to pay you more frequently. All right. To keep that receivables number down. Also, for some customers, the ones that are your worst payers, you could call them up and say, I'm sorry, we're revamping our receivables and credit review. We've reviewed your account and we've determined that we can't do business with you on a company credit basis anymore, but we will take credit cards with the order. We will take a credit card number with the order. All right. Or we will take a check on delivery. I was once in a computer hardware manufacturing business where the industry practice was cash on delivery. And the vendor figured they were giving you credit if they were willing to take your company check when the delivery was made and not cash with the order before sending it to you. All right. Now, all this involves communication. It involves calling your customers. It involves following up with your customers. Yes, it's a lot of work. Yes, you may need a staff person to do that, but that staff person should be worth the value of that faster cash flow in. All right. And again, using a professional call, professional collection techniques, not hectoring them for payment, but just calling to follow up, talk to them, show empathy for their problems getting cash in the door, and at the same time, making sure that you're in the top of their mind. Now, we talked about using revolving lines of credit. One other borrowing method is called factoring. That is where the lending organization actually buys the invoice from you and they take it on themselves to get the money for that invoice. That's a very expensive way to do things because they've got to set up their collection department to do that activity. But it is used in some industries, mostly the fashion industry. Also, you can use a lockbox service at your bank so that your customers send their payments directly to the bank. The bank processes it overnight the same day it receives it, and then sends you the payment information that came in with that payment for you to process through your accounting system. If you get it first and process it through your accounting system first, it might be 1 or 2 or even 3 days before it gets to the bank. That lockbox speeds you up by that much and makes your availability that much faster. Now, slowing down cash going out. The first thing you have to do is keep in mind that your vendors are deserving of getting paid, obviously, and you want to be dealing with them from an information-based basis, which means you need to know what your forecast is, you need to know what you're tracking against, you need to have a good idea of what's going to happen in the future. And then you need to analyze your vendor list very carefully. Who are your best or most important, let's call them your most critical vendors? Those are the people who, if they don't ship goods to you, you're out of business. So you want to put those up top, those critical vendors up at the top of your payment list so that you treat them very, very well in terms of paying within the terms that you've got set with them, all right? Then there's another group of vendors that are maybe one step down. Maybe they're vendors that you can slow up a little bit on from time to time, not always. And you can prioritize them behind your critical vendors. And then finally, there's a group of vendors you might deal with once a year or so, and maybe they're your lowest priority for payment. In all cases, when you call them, you need to call them in order to say anything about any change in your payment pattern to them. You can't just stop paying them and say, okay, I'll pay them next month. They get very nervous when that happens. But if you communicate with them first, tell your story, and then say, based on my cash flow forecast and what I'm tracking against, I need to pay you this month's shipments next month. If you communicate and tell your story, you keep them very much more confident in your ability to pay because they can see from your conversation about forecasts and tracking, they can see that you are on top of your business, that you're paying attention to your business, that you have their interests in your mind, and that you have a mutually acceptable approach to slowing payment to them when you need to. All right. But in all cases, you've got to communicate. You've got to tell your story. Now, in the same way that you prioritize your vendors, you also have to prioritize your expenses. Yeah, right. That's easy for me to say. But just the same way you analyze your vendor ledger, you analyze your expense ledger. What is it that I am doing that I can delay, that I can push off to the future? All right. You have to analyze your payroll carefully in the same way. What are each of the positions I'm filling and paying doing? Are what they are doing critical to the business today, or can I delay somehow that function for a while? It is the most difficult thing in business, and I know this because I've had to do it, to sit down and say to a good performing, nice person, good employee, that I'm sorry, I don't have work for you. It is absolutely devastating to have to say that, because it's no fault of their own that they're suddenly going to be without work for some period of time or even permanently. But you have to be ready to do it. You have to be ready to go out and say, I can function, the business can function without this position, without this deal of work being done for whatever period of time you have. It might be a temporary. You might be able to conduct a layoff and say, I have to lay you off. I'll have more work for you 2 months from now based on our cash flow forecast. Or it might just be permanent. We have to cut this position because we have to readjust how we do the work in this department. You also have to analyze all the outsourcing opportunities that you have. These days, you can outsource almost every single aspect of your business. You can outsource accounting and bookkeeping. You can outsource human resources. You can outsource manufacturing. You can outsource service. You can outsource marketing, sales, all of that stuff. But when you do that analysis, one of the things you should do first is to analyze what is it that is the core of the value I add to customers. And you keep that function in your business, whatever it is. Okay. And then you go about saying, okay, what are the functions outside of that? And how can I outsource them? That gives me more flexibility usually. And it also may save me some money versus having a full-time person on staff. At some point, as things get tough, you just have to say, I'm going to do without that. I'm going to not do this piece of business, this function, this expense that I've been incurring. I'm simply not going to do that for some period of time. All right. And the whole idea is to delay and catch up later. Right. And bottom line, bottom of that, don't eliminate marketing. Remember, your customer base will erode. And if you take your name out of the marketplace, your competitors will immediately call up all your customers and say, hey, I don't see anything from so-and-so anymore because your competitors are watching your marketing too. I don't see any ads from so-and-so anymore. They must have gone out of business. Why don't you buy from me? Right? Don't eliminate marketing. Don't eliminate keeping your name in front of your prospective customer base and your existing customers. All right. You might cut it back. You might cut its frequency. You might cut its breadth a little bit, but don't eliminate it. Now, in an emergency, all the bets are off. What we have to do in an emergency is slow down, delay cash going out, speed up cash coming in. And the idea is delay and catch up, speed up and provide later. All right. Now, what do? Decelerate. We go to negotiate with vendors. More than just the normal course of business, we call them up and say, this is the situation. Here's what I see coming down the pike. Here's what I'd like to do about it. And the idea is delay and catch up later. All right. Same thing with your landlord. Delay and catch up later, maybe over the term of the lease. You know, can I delay lease payments for the next 3 months and then catch up over the balance of the remaining lease? All right. Delay and catch up. Same thing with the bank. Call the bank. Can we get some forbearance and delay the next 2, 3, 4 payments and catch up over the balance of the loan, or catch those payments up by making a double payment beginning 4 months from now for the next 4 months. All right. Those are the kinds of things you want to talk to them about. But again, you're speaking from a position of power because you have information. You have that information and you can impress your vendors and stakeholders with the fact that you know what's coming. You can see it coming because you forecast it and you've been tracking against that forecast and refining that forecast. All right. Similarly, accelerate the money coming in. You could do it by, if you're in a service business, offer your customers a prepaid service contract. Make them a deal. 14 months for the price of 12. Pay now. Prepaid subscriptions the same way. I'll offer you an extra 2 months of subscription service if you pay now for a year. All right. Gift cards are popular in retail and restaurants. They bring the cash in today in exchange for a hamburger tomorrow, just like Wimpy and Popeye. Okay. Advanced contract payments. If you do business on contracts, write an advanced contract payment into your new contracts because it usually takes you a little time and some effort and some money to set up a new customer, to get a new customer's contract activity staged and ready to go before you actually start in on it. Similarly, accelerate, find and apply for disaster and relief loans well in advance of actually needing them. The time to apply for the PPP is not the day you can't make the payroll. It's the day that you find out you're going to need to make a payroll without the sales to support it. All right. Those all in an emergency. Accelerate, accelerate. Keep at the top of your mind. What can I do? What is going to happen? What can I offer my customers or offer my stakeholders, my vendors and landlord and bank? What can I offer them to help them work with me through this? All right. And your vendors and stakeholders will appreciate and have more confidence in you because you're demonstrating that you have looked ahead and you have found that a need and you have the information to back up what you're proposing to them. All right. Now, let's turn to record keeping a little bit. Keep your basic bookkeeping up to date. Every week of the month, there should be entry of transactions into your records and books. You should be staying as much up to date as you can right through the end of each of your fiscal months. By doing that, you get the ability to pull off profitability, balance sheet, and cash flow statements that are also up to date. They're complete. They give you information that you can compare to your forecast, and you can think about why your actual was different from your forecast. There are also many pandemic relief programs running now, both from the federal level, the state, and city of Albuquerque, at least, Santa Fe sometimes. Each of those programs has specific requirements for what you get the money for and what you get to spend it on. Establish sub-accounts in your accounting system for each loan and grant that you might get, because sooner or later, somebody's going to come along and say, prove to me that you spent that loan on what you were supposed to spend it on, that you spent that grant on what you were supposed to spend it on, okay? And being audited that way goes beyond bookkeeping, because you have to have original entry documents in order to support the bookkeeping entries that you showed or you used when you accounted for that grant or loan to the people who gave it to you. All right. They all require reports. Tell us what, here's money. We want you to spend it on this. Now tell us what you spent it on. Okay. So beyond bookkeeping in your computerized accounting system, you're going to want to have payroll records. You're going to want to have a lease that shows what you paid or what you were obligated to pay each month. You're going to want to have utility bills. You're going to want to have invoices. You need evidence of original payment or receipt. That's what satisfies an auditor. And you want to go into that record keeping and you want to make sure you're keeping it up to date. And you can do that by working with your independent CPA or your bookkeeper, whether he or she is in-house or from a service. You want to make sure that you're giving them what they need every month so that you're fully up to date all the time. And that's important because otherwise your tracking information, your tracking data isn't complete and you can't compare it properly to your forecasting data. So when you start talking to people, you're talking to them with bad data, bad information. By keeping your record keeping up to date, your bookkeeping up to date, your statements up to date, now you've got real-time tracking against your forecast and you can make sense to all your stakeholders. Okay. Now, I'm not going to go into all the resources in small print on this page. You'll get this in your copy of the slides, but there's a lot of information out there about cash flow management. I will point out Philip Campbell's book, Never Run Out of Cash, and his accompanying website that sets forth a more detailed approach to taking control of cash flow that I've described here in the time that we have. Also, there are New Mexico COVID-19 business resources to keep in mind. The Department of Health has safe practices for every employer, every industry. There are safe certified programs to work with. There's OSHA information, CDC information, all kinds of information here are some links to some of that information. Now, you can contact SBDC at the website, nmsbdc.org, the email info@nmsbdc.org, or the 2 phone numbers that are right up there. You can also contact the U.S. Small Business Administration through their website at sba.gov. The phone number and the email there relate to their disaster customer service group, which is responsible for issuing economic injury disaster loans and programs of that sort. You may find that those are quite busy lately, but they are there, and the numbers, we've provided them there for you. Now, I want to acknowledge again, Philip Campbell, as if I haven't done it enough. His book, Never Run Out of Cash, was one of the principal sources of information for this program. The National Federation of Independent Businesses, or NFIB, has a large archive on its website of resources for cash management, as does Inc. Magazine in its online archives. And then finally, the SCORE Association's Albuquerque chapter is the strategic partner with SBDC for the development and presentation of these programs, and I want to acknowledge their participation in this as well. Questions? If you have a question, please write it down now. I'll wait. The beautiful Leslie will relay them to me as they come in. We will talk about those questions that you may have on this. Leslie?
We don't have any questions, and I'll give everyone a chance to type in any questions that they do have. Let me remind everyone that we have Tommy next week. He's going to be here on Thursday, I believe. And the reason why I'm bringing that up, because you guys attended today, if you have questions, we're going to be giving you the slideshow. So if you have questions, you can bring them back next week, and I can definitely ask them to Tommy and he can answer. Also coming up, we have 2 bilingual sessions, one on transitioning to the new normal and one on accessing financial resources. We also have buying a business coming up on Wednesday. We have Eddie Midland, another one of our SCORE volunteers. He's going to be coming up this evening on 3 steps to attracting and retaining customers. That's going to be a good one. We have another SCORE certified mentor, which I'm excited about, at the end of the week. And that's going to be Peggy McDonough, who's going to be talking about, are you tax ready? Tax implications if you received a PPP, idle or employee retention tax credits. And she's really up to date. So she gives us the latest information that you need for your small business. And that's all I have coming up this week. Quite a bit.
Yes, it does sound like quite a bit. Thank you, Leslie. And now I'm not that good. I mean, you should have questions. You should be writing them down. Or if you have these questions occur to you later, then by all means, please feel free to attend a future seminar. Basically, it's Tuesdays at 9 and Thursdays at 10, all the way through the end of September. So I want to thank you very much for your participation today. Got 1 or 2 little things to still do here. First of all, next steps. I've given you the tools this morning for you to go off and begin to develop your own cash flow forecast. Do it today. Start today. Sure, it may not be a full month of September because we're already a week into it, but start today. Because if you don't start today, that cash flow disaster that's going to happen out there 9 or 10 months won't be known to you for some time. So start today to do your forecasting. Start today to make sure you're tracking, and get going on keeping cash flow, the king, in the top of your mind. All right. Now, again, you can go to nmsbdc.org for further programs, for business counseling, for loan application assistance. There's a variety of other resources there. Also, please, 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 you'll receive a survey about this program afterward. Please complete that survey. Please send it back. Your responses to that survey help me to develop and to improve this program going forward. So thank you very much for responding to that survey in advance. You'll get it in your email a little while. And I really do appreciate the comments that people make. on it coming back. That's very important to the success of these going forward. So with that, if we don't have any questions and nobody wants to chime in, let's see what's on chat. Okay, these are the links that Leslie sent. So they're there for you. Before we close them, you might want to copy them and throw them into a document or something before Leslie closes the meeting. But with all of that, I want to say thank you. Thank you for your attention. Thank you for participating. And that's all, folks.
Thank you as always, Tommy. I really appreciate, and I appreciate you giving us the great information. You guys have a great rest of your week, and we'll see you at the next webinar. Bye, everybody.
Bye-bye.